If I handed you two companies today, one has been cut in half over the last 3 years. The other just hit another all-time high. Which one would you buy? Most investors immediately look at the stock chart, but I've learned that's usually the wrong place to start. Stock prices move for all kinds of reasons: fear, excitement, analyst upgrades, breaking news, economic data. Sometimes those price movements are justified, but sometimes they're wildly disconnected from what's actually happening inside the business. That's why when I research a company, I almost completely ignore the stock chart at first. Instead, I ask a simple question: is this business getting weaker or stronger? Because over the long run, stock prices tend to follow business performance, not headlines, not hype, not social media, the business itself. I like to say investing is simple, but it's not easy. The concept is incredibly straightforward. Find great businesses, buy them at a reasonable price, and hold them for a very long time. Simple. The difficult part is answering two questions. What exactly makes a business great? And what counts as a reasonable price? And that's what today's video is all about. Over the last year, I've been building Yieldr around the exact research process I use personally. I wanted one place where I could evaluate an entire business in a few minutes instead of opening earnings reports, SEC filings, spreadsheets, and a half dozen different financial websites. Today, I'm going to walk you through that exact process. Then we're going to investigate 3 companies together. One passes every test and becomes an immediate buy candidate. One is an incredible business, but the stock is simply too expensive. And one is a company I would pass on today, despite being one of the most recognizable brands in America. By the end of this video, you'll know exactly why each company ends up in a different category. So let's get started. Every business I research has to prove something. It has to prove that it deserves my capital. And to do that, it has to pass 8 tests. Not 1, not 2, all 8. Every great business leaves clues. Our job is simply to recognize them. Here's the framework I use. First, I need to understand the business. If I can't explain how a company makes money in a few sentences, I stop right there. Second, I want to know how efficiently management allocates capital. That's where return on invested capital and return on capital employed come in. Third, I want to see consistent free cash flow growth. Cash pays dividends, cash funds buybacks, cash reduces debt, and cash grows intrinsic value. Fourth, I look at the margin structure. Healthy margins tell me that the company has pricing power and operational discipline. Fifth, I check the balance sheet. I'm looking for businesses that generate plenty of cash without relying on excessive debt. Sixth, if the company pays a dividend, I want to know whether it's sustainable, not just today, but over the next decade. Seventh, only after all of those quality tests do I think about valuation. Even the world's greatest company can become a poor investment if you pay too much for it. And finally, I check the latest news. Not because I care about daily headlines. I'm looking for structural changes. Has something fundamentally changed about the business? Or is Wall Street simply overreacting? And that's my framework. Now, obviously, I can't manually do this for thousands of companies. And that's why I built the Yieldr Quality Score. The score isn't meant to tell me what to buy. It's meant to tell me where to look. You can think of it as a filter. Instead of spending hours researching mediocre businesses, it quickly identifies companies that deserve a closer look. From there, I still manually walk through every single step we just discussed. The quality score starts the conversation, but it doesn't finish it. Now let's put that framework to work. We're going to investigate 3 companies: 1 buy, 1 watchlist, and 1 pass. Let's see what the data tells us. Let's start with our first company, Automatic Data Processing, or ADP. Before I look at a single financial metric, I always want to understand the business. ADP provides payroll processing, human resource software, and workforce management solutions to businesses around the world. Now, why does that matter? Because payroll software is incredibly sticky. Once a business integrates payroll into its operations, switching providers becomes expensive, disruptive, and time-consuming. That's exactly the kind of business model I like to own. Recurring revenue, high switching costs, and mission-critical software. Now let's see if the numbers support that story. The first thing that jumps out inside Yieldr is the quality score. ADP immediately screens as one of the highest quality businesses in the market. And that's our invitation to dig deeper. So I move straight to the profitability metrics. The very first number I notice is the return on invested capital, 25.5%. That is an exceptional number. Very few companies are able to consistently generate that level of return on every dollar they invest back into the business. Its return on capital employed comes in at 33%. And when we look at the historical ROIC chart, those returns have remained consistently strong over the past decade. That's our first clue. This business has a durable competitive advantage. Next, I check free cash flow. Annual free cash flow is $12.84 per share, with both the 5 and 10-year free cash flow CAGRs sitting comfortably in the mid-teens. Nothing flashy, nothing erratic, just steady, predictable compounding. Personally, I love seeing that. When I look at the margin profile, everything reinforces what we've seen already. The gross margin sits at 47%, and the operating margin is 19%. Healthy margins mean more revenue ultimately turns into free cash flow, which is exactly what shareholders want. Now, let's stress test the balance sheet. My favorite metric here is the free cash flow to total debt ratio, and ADP has a ratio of 1.2, which means it generates 20% more cash than all of its outstanding debt. To me, that is very strong liquidity. A ratio of 0.3 is considered strong here, and ADP's ratio is 4 times better. Debt to EBITDA sits at just 0.16, and interest coverage is around 9. Those numbers tell me that ADP has absolutely no trouble servicing its debt. Instead of sending cash to lenders, management can continue investing in the business, buying back shares, and rewarding shareholders. And speaking of shareholders, let's check the dividend. ADP has one of the best dividend track records in the market. It's a dividend king with 50 years of dividend increases. Its latest dividend increase was 10.39% in November of 2025. And this was right in line with the 5 and 10-year dividend CAGRs of 11 and 12%. Its payout ratio is approximately 59% and has remained steady over the last decade, leaving plenty of room for future increases. Safe, growing, and well supported by cash flow. Exactly what I want to see. At this point, the investment thesis is looking incredibly strong. The only remaining question is, what price are we paying? When I switch over to the valuation page, I can immediately compare today's valuation against history. ADP currently trades at roughly 21 times earnings and only 17 times free cash flow. Now ask yourself, would you be happy owning a company earning over 25% returns on invested capital, producing billions in free cash flow, maintaining one of the best dividend track records in the market, at under 18 times free cash flow? Personally, I think that's a very reasonable price for this level of quality. And finally, I scan the latest headlines. I'm not looking for daily news. I'm looking for permanent changes to the business. And honestly, I already own ADP, so I'm well aware of the latest headlines, and there is nothing alarming on the horizon, other than the potential AI disruption narrative in the media. In my opinion, the payroll business remains incredibly sticky. Demand is stable. The balance sheet is strong. Management continues allocating capital intelligently. For me, ADP passes every single test. Investment thesis approved. This is exactly the type of business I want to own for the next decade. Now let's look at a completely different situation. Applied Materials, ticker symbol AMAT. If you've watched my channel for any length of time, you already know that I love this business. Applied Materials builds highly specialized equipment used to manufacture semiconductor chips. No semiconductor fabrication plant exists without companies like Applied Materials. They sit right at the center of AI infrastructure. So naturally, when we open Yieldr, the quality metrics look incredible. Current ROIC is around 21%, and return on equity sits near 40%. Looking at the historical data, management has consistently generated elite returns on capital for years. but it's been trending lower over the last 5 years, from a high of about 34% in 2022. That's not ideal, but a ROIC of 21% is still very healthy. And healthy is exactly what we want. Free cash flow growth has also been outstanding, with the 10-year CAGR sitting around 15%. Free cash flow per share has dipped in 2025, but the long-term trend is still very nice. Margins remain exceptional. The gross margin is just about 49%, with the operating margin sitting around 29%, and the net margin also around 29%. So this is an incredibly profitable business. Now let's check financial stability. The free cash flow to total debt ratio is 0.92, which tells me that a single year's free cash flow can cover almost all outstanding debt. That's a very sustainable position to operate in. Interest coverage is also an outstanding 31, with debt to EBITDA being very low at 0.01. The dividend payout remains conservative, with a payout ratio of about 13%. Dividend increases have also been exceptional, with the 1 through 10-year CAGR sitting in the mid-teens. The latest dividend increase in March of this year was a very nice 15.22%. The one less than desirable metric is the forward yield, which is just 0.34%. For me, that is acceptable for the quality of business you're getting here, but it may not be an ideal stock for all dividend investors. So everything continues pointing in the same direction. High-quality business, strong balance sheet, excellent profitability, and fantastic management team. At this point, the investment thesis looks almost perfect. But remember what I said earlier. Even the world's greatest business can become a poor investment if you pay too much. So let's click over to the valuation. And here's where everything changes. Applied Materials currently trades around $627 per share. Its current PE ratio is roughly 59, and its price to free cash flow multiple is approximately 83. Those are enormous multiples. Think about what the market is saying. Investors are assuming today's incredible growth continues almost flawlessly for years into the future. Maybe it does, maybe it doesn't. But at these valuation levels, there's very little room for disappointment. One weak quarter, one slowdown in semiconductor spending, one pause in AI investment, and that valuation could compress very quickly. But notice something important. Nothing about the business changed. The quality is still exceptional. The management team is still outstanding. The balance sheet is still incredibly healthy. The only thing that's changed is the price investors are willing to pay. And that's a critical distinction. Great business, wrong price, for me. Applied Materials doesn't fail because it's a bad company. It fails because the valuation no longer provides an attractive margin of safety. So my investment thesis is to put this stock on my watch list. Because this is exactly the kind of company I want sitting on my watch list, ready for the next meaningful correction. I already own a position in the stock, but I purchased shares when the valuation made more sense. So I'm going to sit patiently and wait for a better entry point. And finally, let's look at a company almost everyone knows, Home Depot. Historically, this has been one of the greatest companies in America. An incredible wealth compounder, an iconic brand, a phenomenal management team. So let's see what the numbers tell us today. When we open Yieldr, nothing immediately looks disastrous. But unlike ADP, the clues start changing. The first thing I notice is that Home Depot is still a highly profitable business, with a ROIC of about 20%. Similar to Applied Materials, the ROIC has been trending lower over the last 5 years, from above 30%. Again, that's not ideal, but it still remains at an attractive level. Free cash flow tells us a slightly different story. We can see that free cash flow per share peaked in 2021, followed by 2 years of decline. Then it popped again in 2024, and once again declined last year and over the trailing 12 months. The long-term CAGR is still very nice at about 11.5%, but these spikes and declines are a little concerning. Margins are still strong, with the gross margin at 33% and the operating margin at 12%. But let's take a look at the financial strength. Liquidity has been trending lower as well. The free cash flow to total debt ratio is currently at 0.25, which is pretty decent, but we can see a long pattern of gradual decline since 2012. Interest coverage is still strong at 8.6, but again, we can see a consistent decline since 2022. So Home Depot is still pretty safe financially, but the downward trend in both these metrics is something to keep an eye on. Now, let's compare that slowing growth against valuation. The current share price sits around $349. Yieldr estimates an average fair price around $334. So despite weakening growth, the stock is still trading at a potential premium. The current price-to-earnings ratio is approximately 25. Its 5-year average price-to-earnings ratio is closer to 21. So investors are paying roughly a 16% premium relative to recent history. Price-to-free cash flow has also expanded to approximately 24, with the 5-year average being about 23, implying a roughly 4% premium. Now here's the problem. If growth were accelerating, maybe those higher multiples would make sense. But that's not what we're seeing. Growth is slowing, cash flow is slowing, liquidity is getting worse, yet valuation remains elevated. We can also see on this page that earnings per share have declined since 2023. And we have another view of the free cash flow per share table with actual year-over-year growth, or a few negative numbers in Home Depot's case. I realize I skipped over the dividend section in the stock analyzer, but that's really because I wasn't in love with what I was seeing, so I decided not to bother. But on the valuation page, we can see that dividend growth has really cooled off, with just a 2.2% increase in 2025 and a measly 1.3% increase earlier this year. Normally, I wouldn't even get to the valuation page here, but I did so as an example, and I wouldn't bother checking the news for Home Depot. I'd probably move on to another stock. But for the sake of this example, there are a few headwinds that can explain why we saw what we saw for Home Depot. Higher interest rates, a softer housing market, and consumers delaying large renovation projects. Those headwinds explain why the business is slowed. Now, could Home Depot become a fantastic investment again? Absolutely. But not at today's combination of slowing fundamentals and premium valuation. Sometimes, doing nothing is the best investment decision. For me, Home Depot doesn't fail because it's a bad company. It fails because today's evidence doesn't justify today's price. So my investment thesis is pass. Maybe 6 months from now that changes. Maybe a year from now. That's why I constantly revisit companies. The goal isn't to be permanently bullish or bearish. The goal is simply to follow the evidence wherever it leads. When Home Depot's metrics start improving, so will its quality score, and that can be a trigger for me to revisit my thesis. Now, let's zoom out for a second. We looked at 3 very different companies today. One became an immediate buy candidate. One earned a permanent spot on the watch list, and one was a pass. What's interesting is that none of those decisions came from looking at a stock chart. They came from looking at the business. And I think that's one of the biggest mindset shifts an investor can make. The stock market is constantly trying to convince you that investing is about predicting what prices will do next. I don't think that's the right question. Instead, I try to answer a much simpler one. If I could buy this entire business today, would I want to own it? Is it consistently generating cash? Does it earn exceptional returns on capital? Does it have a strong balance sheet? Is management making smart decisions with shareholder capital? And finally, can I buy that business at a price that gives me a reasonable chance of earning an attractive long-term return? When you consistently ask those questions, something interesting happens. The day-to-day market noise starts to matter a lot less. A 10% drop doesn't automatically scare you. A 20% rally doesn't automatically make you chase a stock. Instead, you already know why you own the business. And that's what gives you the confidence to hold great companies through difficult markets. And that's really the philosophy behind Yieldr. I didn't build it to tell people what stocks to buy. I built it because I wanted a faster, more consistent way to research businesses using the same framework every single time. Everything we looked at today lives in one place. 10 years of historical financial data, dividend history and growth rates, profitability metrics like ROIC, ROCE, ROA, and ROE, margin trends, balance sheet health, free cash flow growth, historical valuation models built around price to earnings, price to free cash flow, and dividend yield theory. Instead of spending an hour jumping between financial statements, websites, and spreadsheets, I can usually understand a business in just a few minutes. This doesn't replace judgment. It simply gives me better information to make better decisions. And that's exactly how I think investors should use it. Yieldr is launching soon, and we're opening the doors to our founding members. If you'd like to be one of the first people to use the platform, you can head over to yieldrapp.com and join the waitlist. A link is in the description below. Everyone on the waitlist will lock in our special founding member pricing, and you'll also get access as soon as the platform goes live. If you enjoyed this video, I'd really appreciate it if you subscribe to the channel. My goal here isn't to tell you what stocks to buy. There are plenty of channels that do that. My goal is to teach you how to think about investing so that eventually you don't need anyone else telling you what to buy. Thank you for watching, happy investing, and I'll see you in the next one.